But using this method, we calculate a bullishness of 85% and 81%. Can you see there are two numbers? The first number is 85%, and the second number is 81%. Where does that first number come from? I can tell you very simply that first number is a measure of how late the peak is occurring. Okay? Because remember, there are two measures of the bullishness of a cycle. How late does the peak occur, and how much, that's the first measure, and the second measure is what is the position of the final or closing trough of that cycle. So as a result, we get two scores for each cycle. Okay, and the two scores for the first 18-month cycle were 85% and 81%. Okay, what you could do, which I haven't done here, is you could average those, and you could come up with an average figure. Let's quickly do that. So this is equal to the average of that and that. Okay, so in fact the average score there was 83%. Okay, and let's just copy those and do it all the way here, and I'll explain what all these other numbers are. We've got lots of numbers to look at. I hope that you also enjoy numbers. All right, so there we go. So the first 18-month cycle. So let's just go back to the chart for a moment. I pointed out that we are currently in the third 18-month cycle. Okay, here are the 18-month cycle shapes. That's the first 18-month cycle. That's the second 18-month cycle. Here is the third 18-month cycle, and I'm going to do something questionable here. That is that I have already drawn the peak over there. I might be wrong about that this 18-month cycle might come up and form another peak. Okay? But there's a very good reason why I've drawn the peak here and not over here. And that is these very numbers that I'm showing to you. Okay, so let me get there. Okay, yeah, as Jose says, it's a very interesting and it's a very easy exercise. It's very, very easy. You can do it. You can do it at home. So we've got three 18-month cycles. So now I performed this very simple exercise. I've built a spreadsheet, and let me go back to it. And here are the scores for those three cycles. The first cycle, as you can see, gets a first score of 85%, okay, a second score of 81%, which gives us an average score of 83%. Okay, now what does the score mean? Why is it a percentage and all that kind of thing? Okay, 100% is the most bullish cycle that you can possibly get, okay? The most bullish cycle that you can possibly get is 100%. You will never see a 100% bullish cycle. It has to do with the way in which we calculate it, and I won't get too mathematical for you, but you will never see a 100% bullish cycle. You might see a 99.999% bullish cycle. It's a mathematical impossibility to get a 100% bullish cycle. Well, no, let me not get complicated. Okay, so 100% is the maximum bullishness you could possibly hope to get from a cycle. 50% is a cycle that is neither bullish nor bearish. It's kind of halfway in between. Okay, and what about a 0% cycle? That is a very bearish cycle. A 0% cycle is very bearish. But something interesting happens at the other end of the scale. Is it impossible to get a 0% bearish cycle? No, it's not impossible. In fact, it's possible to get negative percentage bearish cycles. So that's a very, very interesting thing that I could spend hours talking about, but I won't. I'll move on. But it's impossible to get a 100% bullish cycle, but it is not impossible to get a minus 100% bearish cycle, or minus 300% bearish cycle. That is totally possible. And in fact, you'll see here we have a minus 22% calculation for a cycle over there. Okay, so that's a very bearish cycle, and I'm going to tell you in a moment what cycle that is. Okay, so and now as you can see, we have two ways of scoring our cycles. The first way has to do with where the peak occurs. The second way has to do with where the final trough occurs relative to the initial trough. Okay, so our first 18-month cycle scored 85% in terms of where the peak was, and it scored 81% in terms of where the final trough was. Now, are those two figures always similar? That's another very interesting question, and the answer is no. Sometimes you get mixed cycles. Mixed cycles are very, very dangerous cycles. Mixed cycles occur when you get a very high percentage, perhaps a very high bullish percentage on your first score, but you get a very low percentage, perhaps a bearish percentage, on your second score. Those are very dangerous cycles. Those are cycles that look as if though they're bullish, and they suddenly turn bearish on you. If you're trading, you've got to be very careful that your cycle does not turn bearish. Okay, but it is very possible that you will get mixed cycles. Okay. I unfortunately don't have time to explain all of the details of this today, because it's a really big topic. But for now, you need to know that you must be careful of mixed cycles. Most of the time, you are going to get cycles that are closely matched. These green cycles, you've probably guessed, are 40-week cycles, and I'm going to speak about them in a moment. But you will notice that from all the cycles that there are here, most of these cycles, both numbers are either bullish or are both bearish. There is only, in fact, one cycle here. I think one cycle, yes. There's only one cycle here, which is this one, which is a mixed cycle. Can you see it has a bullish percentage for the first score, and it has a bearish percentage for the second score. Remember, bearish is anything under 50%. So it's only slightly bearish. It's not very bearish, that second score, and it's only therefore a slightly mixed cycle. But it is a mixed cycle nevertheless. But most of the time, those two numbers are very close to each other. Okay, and because that's the way that cycle shapes manifest. That's the way that they play out. I see a question or two there. Mark, so the peak could be late in the cycle, but the final price much lower than the starting price. Yes, Mark. Exactly. That, if you know your sentient shapes, is called a bear. It's called I don't even know them. It's called a bear E shape, and it's very, very dangerous shape. Okay, it's a cycle shape. It's only one of the 6 bearish cycle shapes. One of the 5 bearish cycle shapes, not including the mixed cycle shapes. But it's a very dangerous shape, so you've got to be very, very wary of it. And in fact, if you were trading intraday recently on the American market, let me show you a perfect example of why you need to be careful of that. And let me show you. Here we go. Let me show you on a. Gosh, I'm sort of really rambling today. I hope you don't mind. It's pre-holiday. It's pre-holiday fever. And I'm trying to find that first 10-day cycle. Okay, and I don't have enough data there, so let me go to 4-hour. Here we go. Okay. All right. So if you have a look at this, I hope I see it. It's kind of a funny scale, but let's just very quickly, and I'm going to rush this a little, but here is the first 10-day cycle in the S&P 500 following the 4th of June trough. And if you were trading on an intraday basis, the first 5-day cycle probably did something like that. Okay, very bullish. You can see that. Very, very bullish. Okay. The second 5-day cycle, I believe the trough was actually probably over here. So ignore that phasing. I think the trough probably occurred over here. So the second 5-day cycle had a fairly late peak. Can you see that? Okay. It's after the midpoint of the 5-day cycle. There's the midpoint of the 5-day cycle. So it had a fairly late peak. It occurred on Monday after the midpoint. Of course, it probably occurred over the weekend, and we can't see it because nobody was trading over the weekend. Those lazy traders were taking a break, so we couldn't see the data. So it might have occurred, of course, on Saturday, and we just didn't know about it. But in terms of the data that we can see, we had a late peak, and then the market fell very hard. I don't know if any of you remember that. I remember that day fairly clearly. It was, what day was that? The 11th of June, because the market just fell persistently. And so the result was that we had a cycle that looked as if though it was a very bullish cycle because it had a very late peak. But then we had a very strong move down to form this trough over here, which was lower than the starting trough over there. Okay, I hope that sort of explains that. Yes, one hemisphere is going dominant pre-holiday. All right, so I hope that answers Mark's question. I've got lots of other really exciting numbers to show you. I hope that you enjoy numbers. So there are several things to notice here. All right, I'm speaking about the actually putting a number to the cycle shapes that we're seeing in this market. And so as you can see, in this left-hand column, or set of 3 columns, I have analyzed the numbers of the cycle shapes for the first 3 18-month cycles. Here is that one. It has a score of 85% and 81%. Okay. Here is the second one. It has a score of 66% and 59%. Notice something? Okay. They're lower. So the second 18-month cycle has a lower score. Okay. Now, why is that? That is because the cycle shapes are affected by the underlying trend or the longer term cycles. So what's happening? What's affecting these cycle shapes? So far we're speaking only about these first 2 18-month cycles over here. Okay. Now this 18-month cycle was the first cycle following the trough of a 54-month cycle. Okay. Following the trough of a 54-month cycle, you would expect the first 18-month cycle to be fairly bullish in shape. Okay. And it was, as we saw. It had an average of 83% bullishness. What about the next 18-month cycle? Do we expect it to be more bullish, the same bullishness, or less bullish? Okay. With a sub-cycle, you always expect the next cycle to be less bullish. Okay. The reason for that is because the longer-term cycles have aged. And what happens when a cycle ages? It starts turning down. Okay? So, therefore, we expect the bullishness here to be less. Okay? Now, if we turn back to our numbers and take a look at the numbers for that 18-month cycle, and there they are, you will see that, in fact, the bullishness of that second 18-month cycle was less. Okay, there it is. There are the scores. 62% average, down from 83% average. Okay, so it was a distinctly less bullish 18-month cycle. Now, we've learned one thing. That is that you can expect the progression of the bullishness of cycles to get worse as you move through the cycles. So let's tie this back finally to what's happening now. Okay, I've mentioned already that we are now in the third 18-month cycle since the 54-month cycle trough of March 2009. How bullish do we expect this 18-month cycle, and I've just drawn a very rough, meaningless semicircle there, how bullish do we expect this cycle to be? We expect this cycle to be, again, less bullish than the previous cycle. Okay, I hope you all understand that. So this one you expect to be very bullish, plus. This one here you expect to be less bullish, let's call it 0. And this